The concept of banking in India can be traced back to ancient times. During the Vedic period, lending and borrowing were common practices. Moneylenders, known as kreditashas, played a significant role in society. They provided loans for various purposes, including agriculture, trade, and personal needs. The Mauryan Empire, with its centralized administration, further developed the banking system. They established state-controlled banks known as adhyaksha, which accepted deposits, provided loans, and issued instruments like hundis. Trade guilds and merchant communities also played a vital role in the evolution of banking. They established their own systems of credit and deposit, facilitating trade and commerce. These guilds maintained records of transactions and often acted as guarantors for their members' financial dealings. In essence, while modern banking institutions were yet to emerge, the fundamental principles of banking were already present in ancient India. The arrival of European trading companies, particularly the British East India Company, in the 17th century marked a turning point in Indian banking. The company established its banks, such as the Bank of Hindustan, primarily to finance its trading activities. These banks gradually expanded their operations, accepting deposits and providing loans to the local population. The need for a more structured banking system led to the establishment of Presidency Banks in the 18th century. The Bank of Bengal in 1806, the Bank of Bombay in 1840, and the Bank of Madras in 1843 were established as quasi-central banks. However, these early banks primarily catered to the needs of the British administration and European businesses. Despite these limitations, the colonial period witnessed the introduction of modern banking practices and institutions in India. The establishment of joint stock banks, the use of paper currency, and the development of a clearinghouse system were significant milestones. The early 20th century witnessed significant changes in the Indian banking landscape. The establishment of the Reserve Bank of India, or RBI, in 1935 marked a watershed moment. The RBI was established as the central bank, entrusted with the responsibility of regulating the monetary and credit system of the country. Post-independence, India embarked on a path of economic development, with the banking sector playing a crucial role. The nationalization of 14 major commercial banks in 1969 was a landmark decision aimed at extending banking services to rural areas and supporting national priorities. Nationalization led to a significant expansion of the banking network, particularly in rural and semi-urban areas. This period also witnessed the establishment of specialized financial institutions like NABARD and SIDBI. These institutions were created to cater to the specific financial needs of agriculture, rural development, and small-scale industries. The 1990s ushered in an era of economic liberalization in India. The banking sector underwent significant reforms aimed at improving efficiency, competition, and customer service. One of the key reforms was the introduction of private sector banks. The RBI granted licenses to new private sector banks, ending the decades-old dominance of public sector banks. This move injected much-needed competition into the industry, leading to innovation and improved customer service. The liberalization era also witnessed the entry of foreign banks, further intensifying competition. Deregulation of interest rates, introduction of new financial instruments, and technological advancements like ATMs and internet banking transformed the banking landscape. Customers now had more choices, better access to banking services, and improved convenience. The late 1990s and early 2000s witnessed the rise of the internet and mobile technology, leading to a paradigm shift in the banking industry. Indian banks were quick to adopt these technologies, ushering in the era of digital banking. Internet banking, initially limited to basic transactions, has evolved significantly. Customers can now perform a wide range of activities online, from checking account balances and transferring funds to paying bills and investing in mutual funds. Mobile banking has witnessed explosive growth, particularly with the increasing penetration of smartphones. Features like UPI, or Unified Payments Interface, have further simplified digital payments. The government's push for financial inclusion through initiatives like the Jan Dhan Yojana has accelerated the adoption of digital banking, particularly in rural areas. Aadhaar-enabled payment systems and the proliferation of micro-ATMs have extended banking services to the unbanked population. Despite impressive growth and advancements, the Indian banking sector faces several challenges. One of the major concerns is the issue of non-performing assets, or NPAs, also known as bad loans. Several factors contribute to the problem of NPAs, including economic downturns, poor credit appraisal processes, and willful defaults. The RBI and the government have implemented various measures to address this issue, such as the Insolvency and Bankruptcy Code and asset reconstruction companies. Another challenge is the need for continuous technological upgradation. The rapid pace of technological advancements requires banks to invest heavily in upgrading their infrastructure and cybersecurity measures. Ensuring financial literacy, particularly in rural areas, remains a challenge. Section 7. Understanding the functioning of the banking industry. At its core, the banking industry acts as an intermediary between savers and borrowers. Banks accept deposits from individuals and entities with surplus funds and lend these funds to individuals and businesses in need of capital. This process of financial intermediation is fundamental to economic growth. Banks offer various types of deposit accounts, such as savings accounts, current accounts, and fixed deposits. On the lending side, banks provide a range of loan products, including personal loans, home loans, business loans, and vehicle loans. To manage risks and ensure profitability, banks carefully assess the creditworthiness of borrowers before granting loans. Banks generate revenue primarily from the interest differential between the interest earned on loans and the interest paid on deposits. Section 8. The Reserve Bank of India, the guardian of the financial system. The Reserve Bank of India, or RBI, plays a pivotal role in the Indian financial system. As the central bank, its primary responsibility is to maintain price stability and ensure the stability and soundness of the financial system. The RBI formulates and implements monetary policy to control inflation and manage liquidity in the economy. It uses various tools, such as the repo rate, reverse repo rate, and cash reserve ratio, to influence interest rates and money supply. It also acts as the regulator and supervisor of banks and financial institutions. The RBI sets prudential norms, conducts inspections, and issues guidelines to ensure that banks operate in a safe and sound manner. The RBI also manages the country's foreign exchange reserves and regulates foreign exchange transactions to maintain stability in the foreign exchange market. Section 9. Public sector versus private sector banks in India. The Indian banking sector comprises both public sector banks, or PSBs, and private sector banks. PSBs are banks where the majority ownership lies with the government, while private individuals or entities own private sector banks. PSBs have traditionally dominated the Indian banking landscape with a vast network of branches, particularly in rural areas. They have played a crucial role in extending banking services to the masses and supporting government initiatives for social and economic development. Private sector banks, on the other hand, are known for their focus on customer service, innovative products, and technological advancements. They have captured a significant market share, particularly in urban areas, by offering a wider range of products and services tailored to specific customer segments. The competition between PSBs and private sector banks has benefited customers by providing them with more choices and better services. Section 10. The Future of Indian Banking, a Digital Horizon. The Indian banking industry is poised for an exciting future, driven by rapid technological advancements, evolving customer expectations, and supportive government policies. Digitalization is expected to be the key driver of growth and transformation in the coming years. Artificial intelligence, or AI, and machine learning, or ML, are transforming various aspects of banking, from customer service and fraud detection to credit risk assessment and personalized financial advice. Blockchain technology has the potential to revolutionize payment systems, trade finance, and security. Blockchain-based solutions can enhance transparency, reduce costs, and speed up transactions while improving security and reducing the risk of fraud. Cloud computing is enabling banks to become more agile and responsive to changing customer needs. However, digitalization also presents challenges, such as cybersecurity threats, data privacy concerns, and the need for upskilling the workforce. As technology continues to evolve, the future of Indian banking promises to be dynamic, innovative, and customer-centric.